Hi, Ben Kingsley here with my April RBA and economic update. Huge amount of stuff to get through this month. Key themes for the month are obviously Ukraine and Russia's war continues, and it's obviously having an economic impact. So we're going to take a little bit of a deep dive into that. China's COVID elimination mandates. They're going to have a problem with supply chain, so we're going to have a look at that as well. And finally, the Australian economy is doing very nicely indeed. But what's next for that? So there's going to be plenty of economic data that we get through in this particular update. So let's first start with Russia's invasion of Ukraine. We want to talk about that in economic terms. Whilst Russia and Ukraine's economies together only account for less than 3% of the global gross domestic product and less than 2.5% of global trade, the war is an economic shocker. So to put that into context, what we are going to see is, further severe supply shocks across the globe, driving up energy, agricultural, and metal costs. Our own Treasury Department is forecasting that it will wipe off 0.75 of 1% of global growth, reducing overall growth from 4.5% down to 3.75. Now, in context, that's $3 trillion in Australian dollar terms. Now, let's again put that into context. That's the entire Australian economy and most of New Zealand's economy combined for 1 year. So whilst peace talks continue, the war in Ukraine continues, and that's problematic, obviously, in terms of what we're seeing around, the great resilience of the Ukrainians in terms of protecting their sovereign state and their free democracy. But we did see in a Fin Review report over the weekend from their foreign correspondents, and this is based on Ukraine officials over the weekend, just how well they're doing. They're talking about Russia has lost 17,500 troops, 130 Russian planes, 130 helicopters, and 600 tanks, and several thousand military vehicles in the last 5 weeks of the war. Now, war is terrible. It's shocking. It shouldn't have started in the first place. But also over the weekend, it's now being reported that Russian forces are regrouping in an effort to take over potentially the Donbass region, which is part of Ukraine's east side, which means that Russia is trying to set themselves up with a bit of an off-ramp win there. And so hopefully that means that we'll see certain activities happening behind the scenes, where if Russia can have their so-called internal win with this potential off-ramp, we hopefully can see some type of ceasefire and hopefully some type of peace deal occurring. However, we're not quite sure of that. There's still lots of reports that this war is going to go on for a reasonable period of time. In the latest news, when recording this update, European Union has also tightened Russia's sanctions and strengthened enforcing additional further pressures on Russia. We also await the standoff with Germany and Austria against Russia's demand to cut off Russia's gas supply after rejecting Vladimir Putin's demand to settle contracts in Russian rubles, which is one of, from a global point of view, is considered a junk currency at the moment. Also, in the past couple of weeks, Germany is saying that it will cease reliance on Russia oil and gas by the end of the year, which is exposing one important bargaining chip Russia's had and currently holds. So although some are arguing that the longer the war goes on, the better, Russia is finding it hard to win, and ongoing sanctions could result in a possible regime change in Russia by their own people kicking Putin out. And even more importantly, sending a very clear message to China that attempting an invasion of Taiwan, then China too will face the Western's economic sanctions response, and that will greatly impact China's export markets and overall economy. So all those prospects are quite tempting for global peace and stability in terms of how the West and the overall economy will look. In the short term, a ceasefire and a swift conclusion to the war has ultimate benefits. And what will that look like? Well, maybe it's Russia getting the Donbass region, Ukraine getting neutrality and keeping its democratic state, but can't join NATO for now anyway. the people of Ukraine can return to their homes and start rebuilding their lives again. Oil, commodity and agricultural prices will retreat from their current highs, reducing supply chain challenges and pushing inflation lower. And finally, the world gets one less war to worry about. So that is, what we're talking about in terms of the humanity and economic story here. So let's hope we do get to that resolution sooner rather than later, because although the prospect of kicking Putin out is a grand one, the immediate economic benefits for the global economy are far better if we can get a resolution and we can move on sooner rather than later. So let's wait and see what happens there. In terms of the US economy, we start with interest rates. In terms of the Fed, the Federal Open Markets Committee, the Fed, OMC, lifted rates by 25 basis points as expected, making their first increase since 2018. The members voted 8-1 in favour of the decision, with St. Louis President Bullard dissenting in favour of a 50 basis points hike. So there was no one saying keep rates where they are to get in top of inflation. It was a very busy meeting. So let's take a look at some of the main points this two-day meeting that they had. The members' median projections was that the benchmark rate to reach around 1.9% by the end of 2020. We're talking about interest rates here, and their projection points to rates reaching 2.8% by 2023. Staying on the interest rate front, the head of the Fed Reserve, Jerome Powell, also signaled that a 50 basis point rate hike remains a possibility at its next meeting in May, noting every meeting is a live meeting. Importantly, the markets have already factored in a 50 basis points rise at this next meeting in May. On reducing the Fed's balance sheet, the central bankers pledged to begin shrinking the Fed's balance sheet in a coming meeting. Powell indicated an announcement could be as soon as May on this front, so we wait to see what they're going to do about reducing the balance sheet. On the interest rate forecast, the Fed revised up its inflation forecast. Core PCE inflation is expected to remain at 4.1% over 2022, previously 2.7%, before easing to 2.6% in 2023. On the GDP front, the GDP growth forecast was cut to 2.8% for 2022, previously 4%. The statement acknowledged the economic implications of Russia's invasion on Ukraine are highly uncertain, but in the near term is likely to create additional upward pressures on inflation and weigh on economic activity. Finally, in wrapping up the Fed's announcements, they reported that they have achieved their goal of maximum employment. In February, the US unemployment rate fell to 3.8%, not far off the pre-pandemic lows of 3.5%. And as a result, wages in the US have taken off. In fact, US wages growth hit 4.5% over the year to December quarter, as measured by the Employment Cost Index. This is the fastest growth rate since the series in decades. On a GDP front, overall, we did see that the December quarter GDP was finalized at an annualized rate of 6.9% in the US. This is down slightly from the second estimate of 7%. The result is the sixth consecutive quarter increase in GDP growth, following sharp declines on the outset of the pandemic. Inflation read, CPI rose to a new 40-year high in February, up 0.8 in the month to a 7.9% reading in the year-end terms. The result was in line with expectations. Core measures also rose further, up 0.5 in the month and 4.6 overall in the year. Plus, inflation is expected to rise further as oil surges in early March post the Russian invasion of Ukraine. On the employment front, the ADP employment in March was slightly stronger than expected and included a solid upward revision for February. Employment rose 455,000 in March, above consensus expectation of 450 increase. February's result was revised up to from 475,000 to 486,000. The pickup in employment in March was broad-based across industries and firm sizes. We mentioned earlier about personal incomes. Personal incomes rose 0.5 in February, while personal spending was up 0.2. In other words, consumers have pocketed some of their higher wages income alongside rising inflation and geopolitical uncertainties. even while most recent COVID waves has receded. Consumer confidence in the US, consumer confidence unexpected strengthened in March despite growing inflation concerns. The Conference Board Consumer Confidence Index came in at 107.2 in the month, broadly in line with consensus expectations of 107. This was an increase from the February outcome of 105.7. However, the February outcome was revised down from the initial estimates of 110.5. Views on the present situation strengthened as the labour market remained strong and COVID cases decline. However, inflation is still impacting confidence. In terms of closing out the US data, finally, we look at retail sales. US retail sales were stronger than expected in February after incorporating upward revisions to January already strong result. Sales results 0.3 up in February, while growth in January was revised up to 4.9 from 3.8. So very, very strong consumer spending and activity happening in the US on the end really of the pandemic going on there. China, let's talk about China. Now, China did a great job early in the pandemic with strong enforced lockdowns, seeing their economy, effectively rebound relatively quickly. So what has changed since then? Well, the Omicron variant is now obviously a more infectious strain, and that's the big challenge they've got. So no other country has been able to eliminate the Omicron strain from their societies, but apparently China thinks with 1.3 billion people, they think they might be able to do this. So highly unlikely. Authorities placed Shanghai in lockdown for mass testing of COVID-19 cases, numbers rise, and other cities have also been through a Chinese government-led lockdown to stop the spread of the disease. We know that this strategy works in terms of reducing the spread, but it comes at an economic cost. When we lock down cities, we reduce production capacities, and we started to see this in China's March's data. So manufacturing activity contracted for the first time since October. The manufacturing purchases index, the PMI, fell to 49.5 in March from 50.2 in February. So that's a contraction. Activity in the service sector experienced a sharp decline also. The services PMI came in at 48.4 in March, down from 51.6 in February. This is the first time the index has dropped below 50 in 6 months. Now, given that China is the largest exporter of goods, this is going to have a global problem when it comes to exports via natural supply chain disruption and a higher input cost with regards to inflation. So, for us, the $64 billion question in China's case is, why are they doing this? Is their vaccine not good enough at reducing hospitalizations or deaths compared to the mRNA vaccines? Or is there a more strategic Chinese government strategy here at play? A bit of an increase on the price of their goods means maybe, more flow of money into China, better wages for the workers. Are they testing the West to see where prices, so what prices will they pay before demand falls for their goods? Not sure, but again, one thing that is for sure is prices for goods coming out of China are going to go up. And this means countries like Australia, the US, who buy a lot of our goods made in China, is going to see, or is going to import inflation as part of the importing that they do. And that ultimately is going to impact our local economies. So this is a developing story around what China is doing to manage COVID and to see basically where they sit in regards to that story, because if they do try this lockdown for extended period of times, it's definitely going to have an impact on China's economy, but also, as I just mentioned, other economies. Looking at their current accounts, just to give you some context of just how big China's exports are versus their import story, the current account surplus came in at 118.4 billion in the fourth quarter. So that's just a quarterly read. This was down from the preliminary estimate of 119.4 billion and was an increase from the 73.6 billion surplus in the previous quarter. In terms of they make and export a truckload of stuff. So that is the problem there if they slow their economy down through COVID management. And that's why it's one of my important themes for the month. Let's now look at the Eurozone. Obviously, the Eurozone has been impacted by what's happening in Ukraine and Russia. Confidence in the Eurozone economy slipped to its lowest level since March of 2021 economic confidence dropped to 108.5 in March from a revised reading of 113.9 in February. War in the Ukraine and fears of rising prices are weighing on economic confidence. March's consumer confidence was finalised at negative 18.7. This is the lowest level in consumer sentiment since May 2020, following the initial outbreak of COVID-19. Surging energy costs pushed consumer price inflation in Germany to a record high since reunification in 1990. The consumer price index jumped a whopping 7.3% in annualized terms in March, up from 5.1 over the year to February. So Germany, the biggest economy in Europe, Germany is definitely doing it tough, but they're also doing their bit against the Russian bullies when it comes to obviously important gas and oil supplies. So they're taking one for the team when it comes to doing the heavy lifting in terms of the Russia sanctions. In the short term of their stance, there will be real economic impact in terms of the German economy, and in terms of what they're doing, the West in terms of rallying to really impact economically against Russia is absolutely a terrific thing, and should bode well for the West coming out the other side as a unified voice when it comes to invasions and other global citizens acting inappropriately. So, ultimately that is the big story coming out of the Eurozone. It is going to be stretched. It's going to be impacted in the short term until we see resolution of what's happening in Ukraine. Equity markets, the start of 2022 has been a tumultuous ride for the equity markets as investors have navigated an array of fresh and existing uncertainties. So I wanted to take a moment to quickly run through some of those key themes, because ultimately it's the same key themes that we're also challenged with regards to the overall global economic story. So the war in Ukraine is always being talked about. Russia's COVID story, which we've mentioned earlier, the growing inflation story, which is really the developing story in terms of how long we will see inflation in the system. That's obviously leading to tightening monetary policy, and that naturally is about addressing the inflation story. We've also got the unlikely but possible chance of a potential recession in the US. Going by those numbers we talked about earlier, the US economy seems pretty strong, but again, confidence around an inflation and getting that inflation genie back in the bottle for the US is going to be a problem. Then that obviously turns our attentions to household debt levels versus saving levels. The cost of money is going to increase, so consumer spending may also slow. That's going to impact some of those equity or businesses, and the continued global slowdown on the back of the conflict continuing, and it may escalate. And so that's obviously the big risk that we've got there. And that's why you're seeing, the levels of volatility that we're seeing in the market are really elevated in the early parts of 2022. And that's why we've seen a correction. And we're also seeing, the volatility being really strong. So we're seeing both Australian and US markets having a tough time of it in the first couple of months. But we did see a real surprise bounce back as people became more aware of what's happening in the market. We did see the markets return. So what are we saying about the markets in the short term? It really is a story of, firstly, the war, getting on the other side of that. And then hopefully we're then starting to see some positive economic impacts if we can. And then the outlook in terms of the medium to longer term is why some of those share prices are returning, because most share investors, equity investors, don't look at the here and now. They do look to the medium term outlook when they're buying their shares and seeing what the future value of that. So it really is going to be a case of what happens with the sanctions in Russia post any hopeful peace deal that we will see hopefully forthcoming sooner rather than later. And then ultimately, what is the inflation story and how that is maintained. If we can manage those two aspects, you'd probably expect to see the equity markets doing well. If those things don't get managed well and we see an economic slowdown and we see business performance starting to dry up, you'll start to see some negative red ink on the equity markets as well. So that's one to watch. Now let's also build on that for the Australian economy. Obviously today the Reserve Governor and the board met, and the cash rate remains on hold at 0.1%. the big story, which would have been discussed in those board meetings, was really around, the Russian invasion and the adverse supply shocks that would result in lower growth and higher inflation. Here's that theme again: inflation, growth challenges, and in terms of the scale and duration of the conflict is ultimately the unknown here, and so that's why it remains uncertain. They also mentioned the disrupt to the energy markets will weigh on global growth and again push up inflation, material increases of a risk of stagflation. Now, stagflation is when you've got high inflation but not necessarily economic productivity and growth in the market. So that's always a risk. So it definitely does make for a tough job in setting monetary policy for the RBA, because they need to balance the economic activity in terms of how they stimulate that with, trying to tame the inflation story that's also in the market as well. So Ukraine and Russian war, with its supply chain, energy and agricultural impact, has accelerated the inflation risk, and this might see the RBA moving the cash rate as early as June. So that is the new sort of dialogue we're hearing most economists talking about. Originally, that was, and as per my previous updates, that was looking to be waiting for that next CPI, the inflation read, that would have been the June quarter and would have been released in July, which would have meant the first time the RBA could move cash rate would have been August. But now, with what's happening in Russia and the Ukraine, the markets are expecting that the RBA will move the cash rate by 0.15 basis points to a cash rate of 0.25 of 1% as early as June, on the back of this further deterioration in terms of the global economy, and that plays out. Now, once this first increase is announced, again, most economists are forecasting the cash rate will move quickly towards a cash rate of around the 2% mark by the end of the year. So make sure you are factoring that into your household cash flow scenarios, people. It is going to be important that the cost of money, the money that you borrowed, is going to increase over the next couple of years. When we actually look at the overall economy, we got the GDP data for the December quarter, which was released last month. So the Australian economy sprung back into action in this quarter with a reading of 3.4% after the Delta-induced contractions of the September quarter when we had those lockdowns. The recovery at the end of 2021 meant that the economic expansion for the year was 4.2%, a very solid pace. And this means that the overall economy at the end of 2021 is 3.4% larger than it was prior to the start of the pandemic. The strong economic bounce was on the back of consumer spending as household consumption surged 6.3%. Consumer spend big on goods and services and discretionary areas, especially clothing and footwear, up 42%. Transport services, including airline travel, up 49%. Hotels, cafes and restaurants up 24%. Again, it is a big month for economic data. Obviously, we also saw the federal government move their budget forward in anticipation of a federal election in May. Let's focus in on the highlights with a couple of points to talk about in terms of the federal budget. Let's get some context around just how big this budget is. The 2022-23 budget documents reveal that total expenditure of $628.5 billion, of which social security and welfare accounts for $221.7 billion, made up the lion's share, alongside funding of health, $105.8 billion, education, $44.8 billion, defence, $38.3 billion, and transport and communication, $18.9 billion. Included was a one-off $8.6 billion package of short-term costs of living handouts aimed at addressing the rising prices we are experiencing on the back of this inflation story. And obviously at the fuel bowser is one of those. The mix of a faster than expected economic recovery and booming commodity prices delivered improvements to the budget's bottom line. So we saw the deficit forecast for the end of this financial year at $79.8 billion, which improved from the latest update we got from December, which was a 99.2 billion projection. So that's definitely coming in. So what does that tell us? Well, it's a clear reminder that when the economy is humming along post the health crisis, the tax revenues really start to come home to roost. Okay, so in this latest budget update, which is the full budget, we saw an overall improvement in terms of government revenue, cost savings of 114.6 billion over the next 4 years. So for the 2022-23, a deficit is now forecast of 78 billion in its latest forecast. What is that made up? On the spending side of things, there are almost $40 billion of new spending or revenue reductions over the next 5 years, which also includes spending into the end of this financial year, which is end of 21-22 financial year. Importantly, more than half of this is set to occur in the current financial year, that one I just mentioned, and the next financial year. So this will add to demand at a time when the economy is strong. And so that's why we're seeing still the outlook for the Australian economy is pretty strong. In terms of the deficit, so despite adding the additional spending that I just talked about, that 40 billion, the budget shows a material reduction in deficits, down 103.4 billion over the 5 years. So several economists are also saying that the budget had some conservative forecasts. So there is upside for further improvement in fiscal position. If the economy continues to perform well, this means an improved outlook for government debt levels. So we'll see if that plays out. So overall, you know, when you grow an economy and you do really well at that, hopefully those government receipts will see those levels of debt, as long as, you know, governments can be fiscally responsible, because history tells us that they have definitely a real interest in spending our money. In terms of consumer confidence, or consumer sentiment, I should say, as measured by Westpac and Melbourne Institute, that fell by 4.2% down to 96.6% in March. This is the lowest reading since September of 2020. Notably, it's the first time since the survey has fallen below 100, indicating that there's more pessimists that outweigh the optimists. But I suspect that that had a lot to do with devastating floods in Queensland and New South Wales, and of course the war. When the sample was taken, we were 1 to 2 weeks only into the war, so that certainly hit confidence during that time. Inflationary pressures and obviously the prospect of higher interest rates were also playing into that pessimistic view. In terms of the property side of things, the time to buy a dwelling index fell 7.7% in March, and it's now reached its lowest level since 2008. The index is closely linked to housing affordability, which has become increasingly stretched alongside the sharp run-up in dwelling prices that we've seen over the last couple of years. Retail spending. So retail spending continues to be very robust. So retail sales jumped 1.8% in February, despite that severe flooding in Queensland and New South Wales. The result follows a revised 1.6% rise in January and takes retail spending 9.1% higher over the year to February. Spending in cafes, restaurants, takeaway food outlets surged 7.9% in the month, hitting a new record high. Spending on clothing, footwear, and personal accessories at department stores was also strong, both up more than 10% over the month. And spending is now well above pre-data levels in all categories. So that is a good story in terms of consumers out there spending away. And that leads into a really excellent unemployment story here. So the unemployment rate fell to 4%, the lowest rate in 13 and a half years. Australia has not had an unemployment rate lower than 4% since 1974. So watch this space, because it's about to be matched or broken in the coming months. Overall, employment rose a terrific 77,400 jobs in the month. And that was driven by the second highest spike in full-time jobs on record of nearly 122,000. So you're probably asking, how do you get 77,400 new jobs, but 122,000 in full-time jobs? It just basically means also a lot of those jobs transferred from part-time into full-time jobs as well. But that is new workers and that transition. Hours worked also bounced by 8.9% in February, a record size rebound from the hit in January as the COVID case numbers kept us all indoors in January. And finally, the other sign that the jobs market is flying, in terms of how we measure this, is the participation rate, which increased by 0.2 percentage points to be an all-time high of 66.4, which also includes, importantly, a notable lift in female participations to a record high level. So that is a good news front in terms of the households. Business confidence, now let's talk about the business side of things. Business confidence improved for the second consecutive month in February, jumping 9 index points to be plus 13. Confidence has now rebounded since the 25-point plunge we saw in December as case numbers spiked as a result of the Omicron outbreak. Conditions also improved in February, partly unwinding falls in December and January. The conditions index picked up 7 points, moving plus 9, comfortably above the 10-year average. Yep, that said, this is February data. We obviously still have some headwinds. They will continue to be businesses reporting import and labour cost pressures. They will also become an increasing concern for businesses. This is especially the case in intensive industries such as wholesale and manufacturing, as well as construction, which is sensitive to both materials and labour inputs. So looking at the business credit growth, we saw an acceleration in February also. On a monthly basis, business credit expanded by 0.8 of 1%, up from a 0.6 in January. This took the annual growth of business credit rate to 9.8%, the fastest in 13 years. Business credit has now expanded over 11 of the past 12 months. So the business story in Australia is one definitely of resilience for the most part, and it's a good sign for the economic expansion going forward. Yep, there are those challenges. And of course, those businesses that are impacted by what's happening with global events are also seeing some of those challenges as well. So that wraps up the economic story on personal and also business. Now let's talk about the related property data. So what's happening in the property space? We'll start with housing credit. It grew by 0.6 in February. This was down from 0.7 in January, despite the monthly decline. Annual growth picked up to 7.8%, which is the fastest pace in 11 and a half years and well above the 10-year average of 5.5%. So good news story in terms of credit. Building approvals, this is the negative story here. So building approvals dropped to their lowest levels since June of 2020, stopping just 1.5% shy of the pandemic era trough. In terms of approvals, plunged a whopping 27.9% in January, the largest fall in the history of the series, which goes back to 1983. This data read most likely has been from the impact by forced isolation and disruptions on the back of the Omicron wave. So whether that was just people weren't able to do their jobs, so we've just seen an odd month or an out of cycle month because of the work not being able to be done. We'll see that in terms of future reads on this. Building approvals have now shed 45.1% from their peaks in March 2021, following a spectacular run in approvals underpinned by unprecedented fiscal and monetary stimulus, which resulted in bringing forward a lot of demand, which we're now starting to see the other side of. So the decline in building approvals are broad-based across public and private sector. So looking at the private sector, houses fell 17.5% in a month, the second largest fall on record. Other dwellings within the private sector include apartments, also plummeted for the month, falling 43.6%. But again, I remind everyone that this data is quite volatile month to month, so it can fluctuate considerably. So we also need to look at the more sort of medium trend. Looking beyond the implications of the Omicron, dwelling demand is strong and there remains a larger pipeline of residential construction work to be done. So whilst the numbers aren't great that we've just seen, the pipeline that has been reported is still quite robust. That said, there are still headwinds, including cost of construction, affordability constraints, labour, material costs. We can go on and on. So it's not all beer and skittles in terms of building approvals and new builds for the next couple of years. There's going to be some challenges there. Let's look at the CoreLogic Mark dwelling prices data that was released last week. So we did see dwelling prices grow. They grew by 0.7 in March across Australia as momentum in the smaller capital cities and regional areas outweighed falls in Sydney and Melbourne. Again, the pace of growth is moderating post the boom conditions that we saw from the previous year, last year's numbers. In annual terms, growth slowed to 18.2%. The slowdown was led by dwelling price declines in both Sydney and Melbourne, Sydney falling 0.2 of 1%, Melbourne falling by 0.1 of 1%. On the other side of the ledger, however, we have seen price growth in Brisbane and Adelaide continuing to outperform, with Brisbane 0.2 and Adelaide 1.9% respectively. Prices have risen by more than 10% across all geographies since December of 2019. However, there have been some variations worth highlighting across the country. Regional areas are up 41.5%. They've definitely outperformed. Across all capital cities, growth rates range from 13.7% in Melbourne all the way up to a current growth range of 40.4% for Brisbane. So it also highlights that there are different markets available. So what does that say? Well, here at Empower Wealth, we're talking to our clients currently about this changing market outlook, whereby those boom conditions across all markets will no longer be the story. Instead, the narrative that we're talking about is one where it's replaced by certain markets performing better than others in the short term. And the broader demand starts to taper off. So we're not necessarily going to see such a strong seller's market right across the nation. That said, make no mistake, there's still going to be plenty of buying opportunities out there and plenty of market worth yours and our time to investigate. So rather than a rising tide lifting all ships, we are moving back into markets within markets property story, which we have talked about for many years when we do start to see corrections or softening of the overall market. So we expect that to continue over the next couple of years. On the back of rising interest rates, and also, that will see less demand, but the overall economy will remain relatively healthy and quite robust. So property supply will still remain tight. We heard the stories there about labor shortages and supply shortages. So on balance, we're there sort of saying that the risk is very much in terms of no material declines in property values, but certainly a softening in some markets after their peaks. And that is common in most property cycles where those value gains are given up by, sort of 3 to maybe 5% in some cases. So our messaging is we are moving towards more of a balanced market. And in some locations, we may even see it move from a balanced market into a bit of a buyer's market where we can negotiate harder on price, and that we haven't simply been able to do for the last couple of years. The other important item that we also need to remind ourselves of is very, very tight vacancy rates around the country. So that means that rental in the residential space will also be quite strong over the course of the next year or two. So there's plenty of things to like about the property market. It's not going to be a booming market, but we're certainly not in any fear of any major corrections outside of any, material, deteriorations of the global economy or even the domestic economy through some black swan event that we just haven't anticipated. So we expect more of a softer landing, even though the media might portray that the boom is over and we're now starting to see price corrections in some areas. So let's wrap up the April economic and RBA update, just touching base on those core themes again. A peace deal between Russia and Ukraine will be a fantastic outcome sooner rather than later. We'll get people out of harm's way. The global economy will benefit from that. And so let's hope Mr. Putin isn't as crazy as we all think he is. In terms of China's COVID story, supply chain issues are going to continue if they continue to mandate lockdowns because it obviously reduces productivity and the ability for them to make goods and export those goods to countries like us. And finally, the Australian economy is doing very well. It is in very, very good shape. Let's hope we're able to maintain that momentum into the winter months in the knowledge that we are going to see another wave of the coronavirus come through as we also have to manage people's lives as well as the economic output. So we probably won't see those lockdowns, but we will potentially see some restrictions in terms of isolations and disruptions to some people's movement, but just not on the scale that we've seen in the past. So all in all, the economy is looking pretty good. Property, there's definitely opportunities in the current market. So that wraps up my economic update for this month. So just remember, until we next catch up, knowledge is empowering, but only if you act on it.